Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
To really get what's happening right now in consumer finance, you almost have to go back to 2008.
Financial crisis.
Exactly. It wasn't just, bad mortgages everywhere. It completely blew up the system that was supposed to stop those bad loans.
It was an indictment, really, that the foundation, those FICO scores,
The three-digit oracles, right?
supposedly, they failed. Didn't identify the real risk. Banks got choked with all that toxic debt.
And that failure, it wasn't just a blip. It showed something deeper, didn't it? A structural problem.
Absolutely. A fundamental flaw. See, FICO scores, they run on this rigid formula. It's pretty old, mainly from the 1950s.
50s tech trying to run today's economy?
Basically, yeah. It's static. It needs long credit histories. Doesn't adapt to how complex borrowers are now.
So it ends up penalizing people who are actually responsible financially?
Millions of them. Just
Yeah.
because maybe they didn't get a credit card when they were 18 or their income pattern is different.
Okay, so that's the opening. The gap that these AI challengers are aiming straight for. And there's one company, Upstart Holdings, really positioning itself to make that whole legacy system, well, obsolete.
You're making a pretty bold claim.
Astonishing, really. Their AI models, they say, approve 44% more borrowers, qualified borrowers.
And deliver those loans at rates that are, 36% lower?
36% lower. While, and this is key, slashing default risks at the same time.
That's not just tweaking the system. That's rewriting the rulebook for credit.
Completely. But for you listening to this, the individual investor, it boils down to one huge question, right?
The core conflict.
Is this actually the start of a multi-trillion-dollar revolution? Is FICO about to become a museum piece?
Or the flip side. Will regulators, the watchdogs in D.C., look at this AI and say it's too opaque?
The black box problem.
Exactly, the black box. And will they just slam the brakes on this whole thing?
That's what we need to figure out. We're going to unpack the data, see if Upstart is really set to conquer, or if it might just crash into that regulatory glare. Okay, let's start at the top. The architect here is the co-founder and CEO, Dave Girouard.
Right. And his background, it's important. Pure Silicon Valley. Not your typical banker.
Dartmouth grad, some time at Apple, then president of Google Cloud. That's serious tech leadership.
He scaled Google's infrastructure, dealt with billions in revenue. This is someone who gets how to build platforms that grow exponentially.
So his vision for Upstart, it came out of that 2008 mess.
Directly. He saw the old scoring models failing people who didn't fit the standard mold. Like maybe a new doctor, high future income, but not much credit history yet.
FICO wouldn't know what to do with that.
Exactly. So that led to the big pivot in 2017. They went all in on a full AI underwriting platform.
And the core idea wasn't just, digitizing the old stuff.
No. The models immediately showed their strength because they looked at way more data points, up to 1,600 variables.
1,600. That's staggering compared to FICO.
Mm-hmm.
What are those variables? Not just payment history.
No, it's trying to find proxies for things like conscientiousness, stability, things FICO completely misses.
Okay, like what specifically?
Things like your field of study in college, your specific job history, maybe specialized training you've had, even how you fill out the application can imply stability.
So that med school grad example, FICO sees a thin file, maybe calls them risky.
Right, but Upstart's AI sees the medical degree, the likely future income, the professional stability, and it prices the risk much more accurately. Lower risk, usually.
It's looking forward, not just backward.
That's the key difference. This huge data set lets them underwrite risk with way more precision than a static three-digit score ever could.
But hang on, Girouard isn't a traditional banker. Scaling cloud is one thing, finance is another beast entirely. All the regulations, the sort of inherent conservatism.
Valid point.
Does this tech-heavy C-suite really have the right instincts for navigating Washington, D.C.?
Well, that's where the rest of the team comes in. You have to look at the whole C-suite. Paul Gu, the co-founder and CTO.
The machine learning guru.
He's the brains behind the algorithms that automate, get this, 92% of all their loans. That automation is critical for keeping costs low.
92%. Wow. So loans get processed almost instantly.
Which leads to that huge efficiency boost. Their conversion rates hit 70%.
70. That's double FICO's typical rate, which is like 35%. People aren't waiting weeks or dealing with tons of paper.
Exactly. And then crucially, on the finance and regulatory side, you've got Sanjay Datta as CFO.
Okay, what's his background?
He brings that vital Wall Street experience. time at Credit Karma, experience navigating IPOs. He understands risk, compliance, the language regulators speak.
So that balances Girouard's tech focus.
Absolutely. And Data's experience is critical for handling the intense scrutiny around that proprietary AI. They very deliberately built a team that understands finance and compliance at scale.
Okay, so zooming out from the leadership, the mission sounds simple enough. Improve access to credit. Deceptively simple, yeah.
But they're really framing it as a fight against FICO, saying FICO's grip excludes, 50 million Americans every year just because of thin files or rigid scoring?
And the market they're targeting is just enormous. We're talking a $3 trillion total addressable market, or TAM.
$3 trillion.
By 2030, their vision is that their AI replaces FICO. They want to approve the invisible primes.
Invisible primes. So creditworthy people the old system just misses?
Exactly. Highly educated maybe, stable job history, but overlooked or mispriced by FICO. It's not charity. It's finding economic inefficiency. They're pricing risk that FICO gets wrong.
And driving this huge ambition, there's a specific company culture. Definitely. It's AI first, human second. They operate under these Upstart way principles, data-driven decisions, rapid iteration.
Weekly model tweaks, you mentioned, not quarterly.
Weekly. That constant learning is their process power. They're always feeding new data in, refining the accuracy.
And they're trying to get ahead of the regulatory concerns.
They have to. They've set up internal employee-led AI ethics committees proactively.
Why preemptively?
Because they need to tackle any hint of algorithmic bias before it becomes a regulatory crisis. They want to lead on fair lending, prove the AI is accurate and fair.
Okay, so the company's actual history, it's pretty dramatic, reads like a classic fintech story. Started in 2012, right after that crisis insight.
Yeah, initially they tried peer-to-peer lending, but quickly saw that wasn't the scalable path.
So they pivoted hard into the AI underwriting. By 2016, they were partnered with WebBank. Their AI was originating loans. And here's the kicker. Already outperforming FICO by 2.5 times in risk accuracy, 2.5 times better early on. Then came the IPO.
The ultimate stress test. Went public late 2020, $20 a share. And then, boom.
Pandemic demand for loans, super low interest rates. The stock just exploded, hit almost $400.
Revenue shot up 268% to $846 million. The market loved that they could approve 27% more loans with lower losses than traditional banks. It seemed like fintech could do no wrong.
The golden era, but we all know how that ended.
Very abruptly. 2022 hit, the Fed started hiking rates aggressively.
And the whole lending sector got hammered. Upstart's originations just cratered, 60% down.
And the stock, which had those crazy high growth multiples, plunged 95%. Catastrophic.
That kind of drop can kill a startup. We saw others disappear. What did Upstart do differently? What saved them?
I think the key was embracing this idea of anti-fragility, not just surviving chaos, but getting stronger from it.
Okay, how? What was the move?
It was a strategic feint, really, diversification. When the institutional money for personal loans dried up because rates were soaring and everyone feared defaults,
They had to pivot again.
dramatically. They started holding some loans on their own balance sheet, about 20% of volume, partly to prove the models still worked in that environment.
Taking on risks themselves.
And critically, they accelerated their push into auto loans. Fast.
That auto loan diversification seems huge in hindsight.
Absolutely critical. Auto loans now make up 20% of their borrower volume. That move cushioned the blow from the personal loan slowdown.
And it proved the core tech wasn't just for one type of loan.
Exactly. It showed the AI was a platform adaptable across different credit types, not a one-trick pony. That's essential for surviving a macro storm like 2022.
And that resilience, that reinvention, it seems to have paid off. The comeback looks real now.
The latest numbers, Q2 of full year 2025, they're quite something. The model is firing again, helped by rates stabilizing.
Revenue popped 102% year over year, hit $257 million.
It's more than just a bounce back. It validates their whole operational approach. Originations hit $2.8 billion, up 154%. That's big.
But the really critical piece is profitability, right?
Yes. The return to GAAP net income profit. They made $6 million compared to losing $54 million before. That's a huge swing.
And margins, contribution margins soared, hit 58%, up 85% year over year. That margin expansion is proof. When volume comes back, their software fee-based model scales incredibly well. So when you combine that crazy growth, 102%, with those strong margins, 58%, that gets you to the rule of 40 metric.
Right. The rule of 40 is just growth rate plus profit margin. For software companies, anything over 40 is generally seen as healthy.
An Upstart score.
It hit 160. That's exceptionally high.
What does 160 actually signal to an investor?
It signals incredible product market fit and just outstanding operational efficiency. Compare that to peers like SoFi or Lending Club. They often have lower margins. Maybe they hold more loans on their books.
So their models are less scalable.
Often, yes. Upstart hitting 160 shows they're getting massive growth and high profitability simultaneously. That's the power of the core software platform model.
Okay, let's simplify the business model itself. Why is it disruptive? You said it's like Airbnb for loans.
Yeah, it's a good analogy. It's basically a tech marketplace. A consumer applies online. The AI instantly crunches those 1,600 data points.
And matches them with a partner bank.
Right. A bank willing to fund that loan at the specific risk-adjusted price the AI calculates.
And for investors, the attractive part is the revenue stream.
That's the genius of it. 90% is fee-based. They take a small cut, like 1% to 2%, on the loan volume they originate.
So they're mostly a facilitator, a software provider, not primarily a lender holding tons of risk.
Exactly. That makes revenue highly predictable. And, importantly, about 70% of that fee revenue is recurring. It comes from existing partners, like Prodigy Federal Credit Union, who have embedded Upstart's system right into their own operations.
That distribution strategy is also key, isn't it? B2B2C.
It's a superpower. They don't need to spend billions on flashy consumer ads. Instead, they partner with over 100 institutions now. Cornerstone Community Financial is another example.
And those partners embed the Upstart API into their own apps.
Right. So one big bank integration gives Upstart access to millions of that bank's existing customers, people who already trust that bank.
That allows for massive scaling without massive marketing spend. Exponential scaling, yeah. And there's a subtle but really important edge here. Compliance. Because the partner bank is technically the lender using the tech. The bank bears the primary compliance burden.
Largely, yes. It shields Upstart's core AI from some of the direct regulatory heat, letting the tech innovate faster.
Okay, but the real value, the competitive advantage, the moat, it all circles back to the tech itself, the machine learning.
The technology is, well, it's genuinely impressive. Those ML models, trained on over 100 million data points now, they predict defaults 5 times better than FICO.
5 times better. Let that sink in. Where does that advantage show up?
They achieve 6 times FICO's risk separation. It mostly happens in those middle credit bands. Say FICO scores between 620 and 680.
Okay, the fair credit range.
FICO tends to lump them together as kind of risky. But Upstart's AI, using those 1,600 variables, can sift through that group and find the 44% who are actually quite safe.
The invisible primes again?
Exactly. And they can offer those people much better rates. That's where they win a huge amount of loan volume.
6 times better risk separation. It still sounds almost unbelievable. FICO's a public company they've dominated for decades. Why haven't they just copied this? Or why hasn't a huge bank just built it themselves?
It's a mix of things. Inertia is a big one. Legacy systems of banks are hard and expensive to change.
And regulatory capture. FICO's strength is that everyone already uses it and regulators accept it.
Right. Its strength is ubiquity, not necessarily technology. Plus, you can't easily replicate Upstart's data advantage now.
The network effect.
Exactly. More banks join, now over 100. That means more loans processed, enriching the data pool. Over 100 million loans worth of data now. That refines the AI for every partner on the network.
It creates a virtuous cycle.
A data flywheel. It's incredibly hard for a newcomer or even an incumbent to catch up to that data lead quickly.
So their core strategy is basically flipping FICO's logic on its head, what you called counterpositioning.
Precisely. FICO excludes based on the past. Upstart includes based on predicted future potential.
And that approach, approving 44% more underserved folks, it's resonating, especially with younger borrowers.
Hugely. 60% of their loan volume now comes from millennials. They've successfully branded themselves as Credit 2.0.
Which drove that 159% transaction surge after REITs stabilized.
And don't forget that process power we mentioned earlier, the weekly AI retraining.
Right, refreshing the models constantly with new data.
That gives them about a 10% accuracy improvement every single year. It's a relentless innovation cycle that's really hard for competitors stuck on yearly updates to match.
Okay, we have to talk about the elephant in the room, the regulatory shadow, the sword of Damocles, as you put it.
The black box. It's the biggest single risk factor.
Regulators, especially the Consumer Financial Protection Bureau, the CFPB, they might look at this proprietary AI and say it's just too opaque.
Raises fair lending concerns under ECOA, the Equal Credit Opportunity Act. They could demand full transparency. a glass box.
Forcing Upstart to show the exact logic for every single loan decision, especially the no's.
And that's the huge technical challenge for any advanced AI, especially deep learning. If you force complete step-by-step explainability.
You might actually hurt the model's predictive accuracy. Trade the edge for transparency.
That's the tension, exactly. So Upstart has to manage that. They're making defensive moves, of course.
Like investing heavily in explainable AI.
$50 million into R&D for XAI, yes. Trying to give regulators enough insight, maybe a translucent box, without revealing the core IP, the secret sauce that gives them that 5x advantage.
And that new low-code platform they launched in 2025, that's part of this too.
Definitely. It lets the partner banks customize and audit the AI outputs more easily, without needing deep coding skills. That apparently helps ease about 80% of the compliance worries at the bank level.
But the government is still the ultimate judge.
True, but we also have to consider the counter-narrative here, the regulatory tailwinds.
Things pushing them forward.
The big one is the full year 2025 FHFA rule making FICO optional for mortgages.
FHFA oversees Fannie Mae and Freddie Mac, right? Huge deal.
Monumental. FICO has something like 90% dominance in the mortgage market. That's the biggest credit market there is.
So this FHFA rule is a crack in FICO's dam.
A massive crack.
Yeah.
It doesn't mean Upstart walks into the mortgage market tomorrow, but it officially opens the door. It creates a pathway for alternative models like Upstart's into that trillion-dollar mortgage TAM.
So, ironically, a government agency is actually weakening FICO's grip.
Actively eroding FICO's moat, yes. That benefits all the challengers. So it's not just regulators threatening the AI. In some ways, they're helping clear the path.
Okay, so personal loans were the start, the proof point. But the plan is much bigger. Platform expansion.
Right. They're aiming for half their total loan volume to come from outside personal loans by 2027.
And that expansion is picking up steam.
Dramatically.
Yeah.
Auto loans are the big success story so far. Already 20% of volume, $560 million, originated in Q2 alone.
And they're not just doing the underwriting there, are they? They're building more into the process.
Yeah, it's becoming vertically integrated. They have this white label showroom tech for dealers. It streamlines the whole financing application right there at the dealership.
Makes it smoother for the buyer.
Reduces friction, boosts engagement by about 25%, they claim. They're tackling the whole customer experience, not just the risk math.
Beyond auto loans, what's next?
Home equity loans, or AELOCs, they piloted that in full year 2025. That's targeting maybe a $100 billion piece of that huge market.
And the really big one.
Small business loans. That's slated for entry, maybe Q4. That's a $1.3 trillion opportunity. Massive.
Wow. So the vision is personal, auto, home equity, small business, becoming the core operating system for lending.
That's the ambition. Conquer these different markets, capture maybe 10% of that overall $3 trillion consumer and small business credit TAM.
If that's the growth plan, what are the key things that could speed it up or slow it down? What should you, as an investor, be watching really closely?
The number one immediate factor, no question, is interest rates.
Lower rates are like rocket fuel for them.
Absolutely. Makes loans cheaper for consumers, brings institutional capital flooding back into the market to buy these loans. Q2 proved it that 154% origination jump came right after rates eased off.
There's a direct sensitivity.
About a 50% sensitivity in originations to rate changes based on recent history. So conversely, if rates stay high or rise again like in 2022, that's the biggest external risk. It could stall revenue growth again.
And internally, what drives growth from within the company?
Two main things. Continued AI improvement, hitting that goal of 10x accuracy gains by 2026.
And just signing up more banks?
Partner expansion, scaling from the 100 plus they have now towards their goal of 500 institutions using their platform.
And the broader market dynamics seem to be helping them now.
Definitely leaning their way. Yes, consumer lending is competitive. FICO's been dominant. But that FHFA decision-making FICO optional is a structural shift.
It gives them a real opening in mortgages.
Potentially a 20% upside just from FICO's moat weakening in that huge market. The market itself is creating an opportunity for the disruptor.
Okay, let's bring this back to the individual investor looking at Upstart. You need that margin of safety, right? Confidence in the company's financial footing, especially after that 2022 turbulence.
And their current financial health, it looks pretty solid. They've got $500 million in cash on hand.
Debt levels?
Low debt-to-equity ratio around 0.4. And crucially, they've swung back to generating positive free cash flow. Reported $40 million positive in Q2, a 200% jump year over year.
So they have flexibility. They can keep funding things like that explainable AI research.
Without needing to raise more capital right now, yes, that financial cushion is important.
And the operational metrics, they back up the AI story.
The numbers suggest they do. That 70% conversion rate is still double the industry average, and the delinquency rate currently around 4.5%.
How does that compare?
It's favorable.
Hmm.
Peers are often seeing rates closer to 6%. That lower delinquency rate is really the hard statistical evidence pointing towards the AI's superior risk prediction.
Okay, what about valuation? How does it stack up?
Well, looking at relative valuation, their enterprise value to sales ratio is about 4 times right now.
Is that high or low?
It actually looks somewhat undervalued compared to other high-growth fintech peers. Companies like SoFi sometimes trade closer to 6 times sales. You compare them to fintechs, not old banks, because the margin profiles like software highly scalable.
And if you try to model future cash flows, a DCF.
If you run a discounted cash flow analysis and project, say, a 40% compound annual growth rate, a 40% CAGR in revenue,
Which seems plausible given the TAM and recent growth.
it suggests an intrinsic value around $120 per share. That's more than double the recent market price, which is about $56.93 as of late September, full year 2025.
Okay, $120 potential versus $57 current price. That's compelling. But let's really stress test this. The bear case versus the bull case. Lay out the arguments for the skeptics first.
The bear case hinges on that cycle sensitivity. 2022 proved they're vulnerable if rates spike or stay high. Institutional funding evaporates, volume collapses. That could happen again.
And the regulatory risk is real.
Immediate and potentially costly. If the CFPB forces major changes due to black box concerns, compliance costs could jump 20, maybe 30%. That would seriously dent those attractive 58% contribution margins.
Competition isn't sleeping either.
No. Rivals like SoFi are growing incredibly fast in some areas, tripling originations. It's a competitive space. So the bears see significant downside risk, maybe back to $40 a share, if Q3 numbers disappoint on revenue or if delinquencies tick up.
Okay, that's the dark cloud. Now paint the bull case. What's the powerful counter-argument? The bull case is simple. It all comes down to the AI's proven edge. That 5x better risk prediction is the key differentiator allowing them to unlock that massive, untapped TAM. And the regulatory environment is actually helping in some ways.
The regulatory shifts, yes, especially the FHFA rule, are actively weakening FICO's monopolies, creating openings.
Yeah.
Plus, macro tailwinds, if we get expected rate cuts, should drive those 50% volume surges we saw in Q2.
And the valuation looks attractive from a bull perspective.
The DCF points towards potential way higher, maybe $200 per share if they capture significant market share. And current metrics, like a PEG ratio around 0.52, suggest it's significantly undervalued right now relative to its growth.
All right, synthesizing all of this for the listener, for you. Is Upstart this trillion-dollar disruptor ready to launch, or is that regulatory risk just too high? Where does the balance of evidence seem to fall?
Looking at the data we have now, I'd say it tilts decisively towards the bull case.
Really? Why so decisively?
Because the AI's performance isn't just theoretical anymore. The return to profitability in full year 2025 proves the model works and scales. And structurally, the regulatory actions, like the FHFA rule, seem to be hurting FICO more than they are directly threatening Upstart's AI models, at least for now.
The core difference holds true.
It seems to. FICO is static, struggles in dynamic times. Upstart's AI is adaptive, a precision tool cutting default while approving more people. And crucially, the way they navigated 2022, that pivot showing anti-fragility,
Proves they can survive turbulence.
it positions them for the long haul in this enormous $3 trillion market where AI adoption just feels inevitable. The odds of regulators completely shutting them down, probably lower than 25% right now.
So for you listening, the single most important metric to watch in the near term.
Third quarter delinquency rates, absolutely critical. Buying into this whole story really depends on that rate staying low, under that 4.5% level.
That's the ongoing proof, the non-negotiable evidence that the AI truly is superior and that FICO is becoming less relevant.
And looking longer term, the really interesting, maybe asymmetric upside comes from the markets they're just starting to enter.
Like small business lending.
Exactly. Girouard talks about pilots there pretty openly. That's a $1.3 trillion TAM. It's a huge stealth growth vector that isn't fully baked into the story yet.
So if the FHFA rule really does normalize algorithmic scoring for mortgages,
Then the whole conversation shifts. It stops being about, is Upstart safe? and starts becoming, when does FICO stop being the default standard for any major loan in America?
And that's the really provocative thought to leave you with. If the government itself is willing to chip away at FICO's dominance in mortgages, the biggest market of all, what happens to the very idea of a single universal credit score when the system that created it is no longer mandatory?
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.